You didn't lose it all at once. That's the part nobody talks about. The financial destruction that quietly defines most people's economic lives doesn't arrive as a single catastrophic event. A crash, a fraud, a disaster with a clear before and after. It arrives in layers, in levels, in a slow, almost imperceptible accumulation of losses so individually small and so collectively enormous that most people never fully account for the total damage. Pointless losses, not the unavoidable ones, not the medical emergency, not the job loss, not the market correction that hit everyone simultaneously. The pointless ones, the losses that served no purpose, that produced no experience, no asset, no memory worth keeping, that transferred your wealth to someone else's pocket without leaving anything, not even the fleeting satisfaction of a conscious choice in return. This video is a map of those losses at every financial level, from the person losing $50 a month to unconscious spending, all the way to the person losing $50,000 a month to structural inefficiencies they've never examined. Because pointless losses don't stop when the income grows. They scale, they evolve, they wear different clothes at different levels, but the mechanism is identical at every stage. Understanding the mechanism is how you stop it. Let's go level by level. At this level, every dollar lost is felt immediately. The account balance responds to every transaction in real time. There is no buffer, no margin, no financial distance between a bad week and genuine hardship. And yet, the pointless losses here are not smaller. They are proportionally larger than at almost any other level. The primary mechanism at level 1 is fee exploitation. Overdraft fees averaging $35 per incident, charged by institutions that know their customers have the least capacity to absorb them. Payday loan interest rates that can exceed 400% annually, marketed specifically to people whose income timing creates temporary shortfalls. Check cashing fees that consume 2% to 5% of a paycheck before it is ever spent. Prepaid debit card monthly charges for the privilege of accessing your own money without a traditional bank account. None of these fees purchase anything. They are pure extraction, the financial system's toll on the people least equipped to pay it. The second mechanism is convenience premium spending. At this income level, the absence of a car means corner store prices instead of supermarket prices. The absence of bulk purchasing power means paying more per unit for everything. The absence of a credit history means security deposits, higher insurance premiums, and rental rates that exceed what the same person would pay with a score 50 points higher. Poverty is expensive, not metaphorically, mathematically. The structural cost of having less money is paid in real dollars every month by the people who can least afford it. The exit from level 1 losses is not primarily behavioral. It is structural. Moving to a fee-free banking institution eliminates the overdraft extraction immediately. A credit union membership changes the borrowing cost landscape permanently. A single behavioral shift, buying in bulk where storage allows, cooking instead of convenience purchasing, changes the monthly loss calculation within 30 days. The losses at level 1 are not inevitable. They are structural traps, and traps once identified can be exited. At level 2, the immediate survival pressure has eased slightly. The overdraft is less frequent. The payday loan is no longer the only option. There is, for the first time, a small margin between income and essential expenses. And that margin, that small hard-earned breathing room, is where the level 2 losses live. The primary mechanism here is social spending pressure. The income has crossed a threshold where participation in normal social life feels financially possible, and the social environment immediately expands to consume the available margin. Dinners, events, celebrations, rounds of drinks, group trips with payment plans, birthday gifts for acquaintances, the slow accumulation of social financial obligations that feel individually reasonable and collectively catastrophic. The person at level 2 is not spending recklessly. They are spending socially, which is a different and more difficult problem to solve because the spending is tied to belonging, to relationships, to the basic human need for inclusion. Every dollar declined is a social cost, not just a financial saving, and social costs are harder to absorb than financial ones for most people. The second mechanism at this level is minimum payment debt management. The credit card that was a lifeline at level 1 is now a fixture. The minimum payment is made. The balance doesn't move. The interest accrues at 22%, 24%, 28%, silently, monthly, permanently transferring wealth from the cardholder to the institution. A $4,000 credit card balance at 24% interest, serviced at the minimum payment, takes over 15 years to eliminate and costs over $6,000 in total interest. The original $4,000 purchase, whatever it was, costs $10,000 by the time the debt is retired. And most people at this level have multiple balances running simultaneously. The loss is not the purchase. The loss is the financing cost of the purchase, compounded over years on items that have long since been consumed, broken, or forgotten. Level 3 is where the losses become structural in a new and more expensive way. The income is real. The lifestyle has expanded to reflect it. And the lifestyle has developed infrastructure, recurring costs, fixed commitments, ownership obligations that consumes the income before the wealth-building conversation can even begin. The primary mechanism at level 3 is depreciating asset accumulation. The car that was transportation at level 1 has become a statement at level 3, new, financed. Expensive to insure, expensive to maintain, and losing value at a rate that no savings account could sustainably absorb going the other direction. The apartment that was functional at level 2 has become a premium at level 3. The location, the amenities, the square footage, all of it upgraded to a cost that consumes 35%, 40%, sometimes 50% of gross income before taxes are paid. Housing costs at this level are the single largest wealth extraction mechanism available, and they are so normalized, so universally accepted as the appropriate allocation of income that almost nobody examines them critically. The second mechanism is subscription and service accumulation, not the $15 streaming platforms of level 1, the $200 gym with the convenient location, the meal kit service, the premium software, the car wash membership, the storage unit holding things that haven't been touched in 18 months, the insurance policies with coverage levels that were never deliberately chosen. Each individual service is defensible. The aggregate is what the level 3 person almost never calculates, because calculating it requires confronting a number that is deeply uncomfortable to see assembled in one place. The level 3 loss is not impulse spending. It is infrastructure creep, the slow, socially validated, professionally normalized expansion of fixed costs that eventually consumes all available margin and leaves the person earning $8,000 a month with the same zero savings rate as the person earning $2,500. At level 4, the income is significant. By almost any demographic standard, the person at this level is doing well. And the losses at this level are the most psychologically complex ones on the entire map because they are purchased deliberately, consciously, and with the genuine belief that they are investments rather than expenses. The primary mechanism at level 4 is status expenditure mistaken for asset acquisition. The watch that holds value, the car that is a classic, the wardrobe that signals professional credibility, the club membership that generates business relationships, the apartment in the right building in the right neighborhood that reflects the appropriate level of arrival. Each of these expenditures has a narrative that justifies it in asset terms, and each of those narratives, examined honestly against the actual financial performance of the item, fails to hold up. The watch that holds value for the collector who bought it at the right price and holds it for the right duration, not for the professional who bought it at retail to wear to client meetings. The car that is a classic requires storage, insurance, and maintenance costs that most owners never calculate against the eventual appreciation. The apartment in the right building costs a premium that far exceeds any networking or professional benefit it might generate. The level 4 person is not being irrational. They are responding to real social signals in a professional environment where the performance of success is genuinely required to access certain opportunities. The error is not in the spending, it is in the accounting, in classifying as investment what is functionally consumption. The second mechanism is financial complexity without financial strategy. At level 4, the tax situation has become complicated. The investment accounts exist, but haven't been reviewed. The insurance coverage was set up years ago and never revisited. The estate planning conversation keeps being postponed. The financial advisor charges 1% AUM and hasn't been evaluated against a benchmark in 3 years. The losses here are invisible, not line items on a bank statement, but percentage points of return, tax inefficiencies, and compound drag that accumulates silently across years into sums that would be genuinely shocking if they were ever assembled into a single number and shown to the person absorbing them. At level 5, the absolute dollar value of pointless losses reaches a scale that would be incomprehensible to the person at level 1, and yet the mechanism driving those losses is psychologically identical to the mechanism driving the $50 overdraft fee at the other end of the map: inattention. Inertia, the assumption that the current arrangement is approximately correct because it hasn't produced a visible crisis. The primary mechanism at level 5 is structural financial inefficiency at scale. A business paying for services, software, vendors, and staff at rates that were negotiated years ago and never renegotiated. A real estate portfolio with financing costs that haven't been refinanced through 2 rate cycles. A tax structure that was appropriate at $200,000 annual income and is deeply suboptimal at $600,000. An investment portfolio with an expense ratio and advisor fee structure that is consuming $40,000 to $80,000 annually in management costs on returns that a passive index strategy would match or exceed. None of these losses feel acute. None of them trigger the visceral response that a $35 overdraft fee triggers for the person at level 1. But the dollar amounts are categorically larger. And the irony is that the person at level 5 has both the resources and the access to eliminate them completely, while the person at level 1 is structurally trapped in their version of the same problem. The second mechanism at level 5 is opportunity cost blindness. Capital sitting in low-yield instruments, not because it was a deliberate allocation decision, but because the initial placement was automatic and never revisited. Business profits distributed as income and taxed at the highest marginal rate when retained earnings strategies were available. Real estate equity sitting idle when leverage could have deployed it into additional appreciating assets. The loss at level 5 is not what was spent, it is what was never built, because the capital that could have compounded was either extracted inefficiently or left idle in an arrangement that was never examined critically.